Hello everyone, welcome back to another episode. I'm your host, the Millennial Investor, and today in this episode we're going to be going over the top 4 stocks that you all should be buying in September of 2020. One of these stocks I've already owned, one of these stocks I currently own, one of these stocks I'm looking at owning, and then one of the stocks is one that I've always been interested in, but I'm not going to be adding it because they cut their dividend, and it's the Cheesecake Factory. And I'll be going over the 4 stocks that I'm potentially looking at adding in this video, and I just bumped up this position. You see this one sticking out right here, Whirlpool? I ended up taking my position down by 1% in Whirlpool and adding it to Jpmorgan. I'm adding it to Jpmorgan. This is the one that is also in this video. I'll be going over my bullish reasons for Jpmorgan, and I just think it's an excellent stock to buy at these prices. I think if you don't believe in Jpmorgan, then you don't believe in the U.S. economy. I think with Whirlpool, just with the opportunity that it has compared to Jpmorgan completely outweighs the opportunity. And with Whirlpool, you see it's up 127%. When I bought the stock, I have an average cost basis of $86 a share. It is nearly $100 a share higher than that, $184. So I'm at a massive gain. You can see that it is well past the 2019 highs, getting levels that haven't been seen since 2017. So not to mention that it has a good dividend. I still like the company. I'm not going to be selling out of it. I did not sell any of my shares. I just lowered my position to where I won't be buying any shares at these prices. I want to wait till it gets back down to the 160s, the 150s, 140s, comes back down to earth a little bit because the fact that I'm already up triple digits on the stock makes a bullish case for Jpmorgan for me to take the money out of there and then focus on Jpmorgan. Because Jpmorgan not only has a better dividend, but I think I'm just more bullish on their business model and the fact that they're so heavily weighted in the U.S. economy. I think they're just going to be able to grow this dividend, return cash back to shareholders, and continue to create book value for the long run when we're talking about Jpmorgan stock. So the 4 stocks that we're going to be talking about in this video is CAKE, ticker symbol CAKE. We're going to be talking about the Cheesecake Factory. This has went down a lot from this recession, and I mean a lot. And while it is merited to some extent, I think it is overblown. I think that not only will all 4 of these stocks, Cheesecake Factory included, not only will it get back to all-time highs, I think it will break well past those all-time highs in the next 2, 3 to 4 years. In the next 2 stocks we're going to be talking about, the one I just mentioned, we'll be going over Jpmorgan Chase. It went down quite a bit from this recession. It has not recovered fully yet, and I think it will get there very, very soon in the next year or two. Bank of America. Bank of America, pretty much the same story, which we'll be grouping these 2 together because they have extremely similar business models, pretty similar valuations, and overall they're just pretty similar investments. And then last but not least, we'll be going over ticker symbol FL or Foot Locker. This was a stock that I used to own when I first started the portfolio. They did temporarily suspend that dividend, so I did sell them out of my portfolio, but overall, guys, I'm still extremely bullish on the company. Great valuation. So in this video, we'll be going over their investor relations page for Cheesecake Factory and for Foot Locker. I'll be going over the balance sheet of all 4 of these companies, and then I will be going through this email right here where I wrote down the PE ratios, the forward PE, the expected 2020 growth, and expected 2021 growth for all 4 of these positions and show you why they are good buys for the long run. And if we have some time left, I might go over a comment or 2 that was left behind you guys. Now, if you're not familiar with me, my name is Jordan. I'm the Millennial Investor. I track my annual dividend income, my monthly dividend income, my portfolio value, and I also disclose something that hardly any other YouTubers disclose. I show my YouTube income, which we're doing very good this month, which we will be breaking that record this month of $184. And there it is broken down by category. So pause the video if you want to check out any of that there. I am full transparency. These are all the dividend stocks that I own, all 30 of them. Actually 29 now. I haven't removed Microsoft. That's not updated till next month. But if you want to support me, how you can do that is you can go here and you can click refer and earn. And in the description, I have this link posted. This can show you how to get set up with M1 Finance. If you download M1 Finance and deposit $100 to the platform, you can get $10 just for signing up. Absolutely free. There's no fees whatsoever. And especially if you're watching this video and you're interested in dividend investing specifically, what you should do is try M1 Finance because by far, in my opinion, it is the best brokerage for dividend investors. Not only is it pretty good for pretty much all investors in general, but for dividend investing, it is next level. And like I said, all these positions will be shared in the portfolio as well in the description of the video. So this link's down below. So go ahead and check that out if you want to check out all 29 of my positions right there and the weights I have behind them. But let's go ahead and get started with the Cheesecake Factory and why I'm so bullish on it. Let's just read this investor statement right here about the Cheesecake Factory Incorporated. The Cheesecake Factory Incorporated is a leader in experiential dining. We are culinary forward and relentlessly focused on hospitality. Delicious, memorable experiences created by passionate people. This defines who we are and where we are going. We currently own and operate 294 restaurants throughout the United States and Canada under brands including the Cheesecake Factory, North Italia, and a collection within the Fox Restaurant Concept subsidiary. Internationally, 26 of the Cheesecake Factory restaurants operate under the licensing agreements. Our bakery division operates 2 facilities that produce quality cheesecakes and other baked products for our restaurants, international licensees, and third-party bakery customers. In 2020, we were named to the Fortune magazine 100 Best Companies to Work For list for the 7th year. Now, this company, in my opinion, is extremely underrated in the fact that they have such great demand considering that we're coming back from this recession. It is not getting the type of attention that I think it should be. Now, they have some incredible brands and incredible dishes here. You see, it's the thumbnail of this video. I'm sure you saw it when you clicked on it. But they have over 300 restaurants spread out over all different locations of the United States and Canada, and they have multiple brands, the Cheesecake Factory, North Italia, and Fox Restaurants Concepts, and they're focused on experiential dining. They're focused on the experience of the customer. They're focused on the quality and the customer experience, and this is something that you don't see with companies like AT&T, for example. They have focused on the business side of things and not focused on the consumer, and this is why their stock price has lagged. That's why I sold part of my position in them. I'm basically just holding on to them for the massive dividend. Now, the one thing that's keeping me from investing in the Cheesecake Factory is the fact that they cut that dividend to zero. If they were to keep that dividend and at these prices, if that was still available, I would have bought them so fast. And I think that they're just a great company, and I think not only for their dividend potential when it comes back in 2021, 2022, I think that in the long run, I think the success of their business will be great as well, and they will get back to profitability. And let's go ahead and jump straight into the balance sheet of this company. Now, I want to go ahead and start off with the income statement, and I want to show the net income. That's mostly what I want to focus on here, and this is on a quarterly basis. So this is the last 3 months, and you can see that their net income applicable to common shareholders was negative 56,000 or 56 million. These numbers are in thousands. So negative 56 million and negative 136 million the previous quarter. Now, this is not a profitable company this year. It has been profitable every single year. It has grown revenues pretty much every single year for the last decade, and they had pretty good net income before that. Now, this number has gotten smaller for this negative number, and I'm assuming the next quarter, or at absolute worst case scenario, the fourth quarter, when everything thrives, they will get back to profitability. And since they're not paying out these dividends, they can focus their money more towards funding operations and getting all that debt paid off and getting things back to normal to where it should be, and then eventually get back to paying those dividends. But with the Cheesecake Factory, I think that they're going to get right back to normal. And when we look at their balance sheet here, they have increased their cash position significantly. You see, just 6 months ago, it was 58 million, now it's 250 million. And their long-term debt is very easy for them to pay off. Considering that the stock has 250 million in cash and their long-term debt is only 376 million, that's about a 1 to a 1.5 ratio, almost exactly, for cash to long-term debt. So they could take that cash, pay off the long-term debt tomorrow if they wanted to, and pay off nearly all of their long-term debt. I think that is a great sign for this company, and considering that they're no longer paying dividends for the short term, I think that they'll have more cash piled up in the meantime, and I think they'll be able to pay off any debts or finance any operational issues that will happen within the next year or so. So Cheesecake Factory, it's just the simple fact of, now that the Rona is coming to an end, why are people not going to dine out when this thing finally gets solved? When people get back to normal, why would this company not go back to normal? So it was trading at $40 a share. Let's say if it never broke past that point and it got back to $40 a share. Even in that scenario, you're looking at a 60-70% gain from these prices. Not to mention if it ever gets back up to the 50s, the 60s, the 70s, where it has been in the past. So the Cheesecake Factory, in my opinion, it's a buy. I think they have a healthy balance sheet, and I think they'll get back to normal in the long run. Now let's go ahead and talk about two of the biggest banks in the world. Let's go ahead and talk about Jpmorgan and Bank of America. I just bumped this position up in my portfolio again today, and that's the third time in the last month. And I just keep on looking at the stock, and I just keep on seeing upside potential. The dividend has increased every year, and both of these stocks are maintaining their dividends even in the worst of the recessions. They build cash reserve piles to prepare if the recession gets worse, and I think that if they don't need those funds, if they set those cash positions to the side and it's not nearly as worse as they expect, well, guess what's going to happen? What are they going to do with those cash reserves? They're going to put it right back into the shareholder's pocket, and that's where someone like me can benefit. So when they're paying nearly a 4% yield with JP Morgan, and they're the #1 bank in the United States, I think that this stock is just an easy buy. Like I said, they create shareholder value and they continue to have massive amounts of net income pretty much every single year. And this jumps me straight to my next position. Let's talk about Bank of America. Bank of America is just one of these stocks that is the exact same as a JP Morgan, huge bank, dominant player. And with both of these, I don't want to say that they're government backed because technically nothing is government backed. It's not guaranteed that they would get bailed out if they had some kind of negligence in management. But let's be honest, if the economy ever got so bad that these stocks were just at the point of bankruptcy, do you think that the Fed would ever let these banks go under? Do you really? Because I don't think so. I don't think that the Fed would ever allow that these banks would to go under because of JP Morgan, Bank of America, Goldman Sachs. If these big banks started going under, what happens to the rest of the economy? They're arguably the most important part of any economy, the big banks, and I think that these are pretty much as close to a safe investment as you can get that is pretty much outside of treasury bonds. I think that these stocks have both had great dividend growth, and I think with their cash reserves, like I said with JP Morgan, same thing with Bank of America, I think that they're going to do great in the long run. And speaking of Bank of America, just a little side note, guess who's been buying Bank of America literally, not even an exaggeration, literally every single day? That's good old Warren Buffett. If you want anybody on your side or to agree with your investment strategy, why not agree with Warren Buffett? They just approved him to increase his position in Bank of America to over 10% ownership. So if you're buying the stock, well, guess what? Warren Buffett already owns 10% of it. And then JP Morgan, he also has a position in as well. But let's go ahead and just look at the balance sheets of JP Morgan. And the main thing I want to focus on is the net income. Because when it comes to bank balance sheets, it gets very hectic. It gets very crazy. With these big banks balance sheets get very weird because of all the intertwining they have between each other, the amount of money that they have on hand versus the amount of money that they have that are in customers' accounts. It gets very ugly. So the one thing I just wanted to focus on between these, I want to look on an annual basis. I want to look at the net income between these two stocks. So here's JP Morgan's, and let's scroll down to Bank of America's. Close this advertisement. Okay, and then JP Morgan. Let's look at the last year, and this was updated at the end of 2019, 2018, 2017. So if we go to the bottom here, this is a company that produces 20 to 30 billion with a B. These are in thousands, just like the other ones. 20 to 30 billion dollars every year in net income. So you're looking at about $3 billion in net income every month. With this stock, they're so profitable that they have no issues whatsoever creating capital and enhancing their business model every year in and out. And they keep on raising dividends, they keep on having share buybacks, they keep on growing that share price, and I think they'll be a great opportunity in the long run. And when we look at Bank of America, same story. They're a little bit smaller than JP Morgan, but it's the same story. $16 billion in net income. $16 billion in net income again. $26 billion, almost 27, and then 26 again. So $26 billion in net income for Bank of America, a little over $2 billion every month. So that is massive amounts of net income, and I don't think that these banks are going to be going away anytime soon. So in my opinion, if you just want a safe, steady investment, with JP Morgan currently paying out almost 4% in dividends and Bank of America almost paying out 3% in dividends, their dividends, the share price gains, I think all that is just an easy money stock if you want to hold these stocks for the long term. Now let's go ahead and look at my last stock. Let's go ahead and look at Foot Locker. And the potential that Foot Locker has is great because they're at an excellent valuation. Now let's go ahead and go to my activity slide here. Let's go and search Foot Locker, if I can type it in, Foot Locker. So Foot Locker, if we go down here to the bottom, when I first bought the stock, I bought it at $19.35 a share. And today, you can see how this stock is going. It is currently at $27 a share. Now, when I sold this stock, I sold it for a gain. I sold it at $28 a share, and currently it's right around those prices today. It's just a couple dollars less than that. So I sold it at a pretty good time. It's lower than that. Considering it's been a couple months, it's pretty good. They no longer have their dividend, which is why I sold it. They cut their dividend right around here, so that's why I sold it, and I don't want to own a stock that doesn't pay me out any dividends. Now with Foot Locker, the valuation is incredible. Let's look at the valuation of all four of these stocks. Now with the Cheesecake Factory, their PE ratio is 9.9, a forward PE of 11.4. Pretty good considering that they're going to bounce back, they're expected to bounce back quite significantly from this downturn in 2020. They're expected a downturn of 20%, up to 31% growth in 2021. JP Morgan, they're expected a downturn in 2020, a slight downturn in 2021, but overall still going to be a very profitable company. With Bank of America, they're expected to get hit a little bit harder in 2020 and they get almost back dead even in 2021. With Foot Locker, they're expected a big bounce back, still a forward PE of only 16, and considering that the stock is nearly going to grow at double digits back from where it expected in 2020, this is a pretty undervalued stock in my opinion. This is a very undervalued stock also on a valuation basis. And not to mention, this stock is pretty undervalued in my opinion when you look at their balance sheet. Now, when we go to their investor relations page, before we get into that balance sheet, Foot Locker leads the celebration of sneaker and youth culture around the globe through a portfolio of brands including Foot Locker, Lady Foot Locker, Kids Foot Locker, Champ Sports, East Bay, Foot Taction, Runners Point, and Sidestep, with 3,100 retail stores in 27 different countries across North America, Europe, Asia, Australia, New Zealand, as well as websites and mobile apps. The company's purpose is to inspire and empower youth around the world by fueling a shared passion for self-expression and creating unrivaled experiences at the heart of the global sneaker community. Foot Locker Incorporated has corporate headquarters in New York, and then yada 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 for more information. But Foot Locker, in my opinion, is just a great brand, and they're targeting young people, and that is what you want to focus on because you will create lifelong customers. It's the same thing that a great business model does, including one of my holdings. It's like McDonald's. Who do they target? They target young people. They make you fall in love with them when you're 5 years old, and then you end up buying their products for 40, 50, 60, 70 years down the road. And then Foot Locker is trying to do the same strategy, and they are expanding their online presence as well. So I think that is a pretty good long-term growth story, Foot Locker, considering that it's a retail store. Now that said, let's look at not only the valuation, but let's look at their balance sheet. The balance sheet is what we're looking at now. 1,000 in cash and cash equivalents, and then when we go to their long-term debt, it's 121. So when you look at those two numbers, the cash is nearly 10 times higher than the long-term debt. So they could literally pay off that long-term debt tomorrow and still have over 900 left in cash and cash equivalents. This is a stock that is financially extremely healthy. This is a stock that could weather through any storm with any types of downturns, any recessions, or any more illnesses that might come through. I think that Foot Locker just provides a great opportunity for anybody that has the chance to be a shareholder. And that pretty much wraps it up for those four stocks, guys. I think that these four stocks are ones that you should buy. And let's go ahead and just look at a comment that was left here by JF. And he wrote, "The millennial investor, why don't you invest in growth or tech stocks? Do you think that will go down after the vaccine?" I don't think that I should be buying stocks regardless of whether or not a vaccine comes out. We've looked at the S&P multiple times in this portfolio, and what I'm focused on is not about share price. I had Microsoft and Apple for their dividends, and while they did have great dividends, or okay dividends more like it, they went up to such high valuations, I thought I should just take some profit and invest it in my other companies. And Apple just hit another all-time high today. You see that it is now $460 a share. I bought this stock at around 250. At 250, this is a great company, but at 460, nearly double that price, I don't know. I'm not a hater on Apple or Microsoft. I just don't really like the valuation. And that big of a run-up, you got to figure at some point it's going to come to an end. And even if I'm wrong, even if they keep on going to new all-time highs, I have no shame in my game. And something I want to point out about the S&P, it currently has a dividend yield of about 1.7%. But when you go to my portfolio, it has much higher than that. If we just take my recent portfolio update and we take $108 and we divide that by the previous share price that I updated last month. So as of last month, at the first day of this month, I had $108 in dividends. And then if you take that $108.40 and divide it by $3,033, my portfolio was currently yielding 3.57%. So 3.57 is literally over double that of what the S&P is yielding. So I'm not so much focused on what share prices are doing. I pay attention to it, I notice it, but at the end of the day, this number, this big number here of $528 is not what I'm focused on. This number right here of $32 in earned dividends, this number will do nothing but go up. This market gain, it might go up a lot higher, it might go all the way back down to zero. I have no idea, I don't have a crystal ball, I cannot predict the future, but I can guarantee you one thing, this earned dividends number is going to do nothing but go up. So that pretty much wraps it up, guys. Thank you guys if you made it all the way to the end of the video. I will update you guys on every single purchase, every single sell, every single dividend that I have in this portfolio. I have full transparency. I disclose everything, even my YouTube income. So if you appreciate the transparency and you want to leave a comment or question just like JF did, feel free to do that down below. And if you want to support me and support my channel, go ahead and use this referral link in the description. I have 23 people that signed up. Go ahead and be the 24th person. And this link is in the description, as I mentioned before. So thank you guys so much for watching. Go ahead and go buy those four stocks that I just recommended, and I'll see you guys next time.